Okay, good morning to the lecture today. So yeah, close to the end of the semester. So there will be the deadline for your term project actually coming up on the weekend. And next week we will have the term project presentations. And there will be also regular lecture next week. Okay, so next week will be regular lecture and additionally term project presentations. Okay. Yes, so content-wise, what are we doing or where are we? Last time we talked about the capital asset pricing model as probably the most famous model in finance. And today we will talk about a second, also very famous model in finance, which is called arbitrage pricing theory. Okay. After that, we will also talk about market efficiency, so that like next time we will talk about unit 6. So today we try to finish unit 5, so next time we can talk about unit 6. So for the final exam, the content that is now on Moodle in terms of lecture slides is actually the whole content. Okay, so there will be no unit 7. So unit 1 to unit 6, what you can find on Moodle now, is also what will be relevant for the final exam, for your planning. And I will talk a bit more about that next week, and I will also write a Moodle forum post or create a Moodle forum post later today in the evening with some more information about the exam. But yeah, there is nothing that should be super surprising, I think. Good. So arbitrage pricing theory. Why are we talking about arbitrage pricing theory? Why is it important? And what is it? So arbitrage pricing theory is basically a second model second equilibrium type model that tries to answer the question what security returns look like. What is the expected return, basically? Okay. And we will see that kind of surprisingly, the result of the arbitrage pricing theory will look quite similar to the result of the capital asset pricing model. But the starting point, the whole way how the APT arrives at this conclusion, is actually very different. Okay? So basically you can think about it as two very different approaches to asset pricing. And kind of surprisingly, they end up with nearly the same result. Okay? So arbitrage pricing theory goes back to the 1970s. It was formally developed by a finance professor called Stephen Ross in 1976. And the key ideas of arbitrage pricing theory are really those three items here. Okay? So you can also think about them as the assumptions of the APT. Yeah? The first idea or assumption of the APT is that security returns are accurately described by a factor model. Okay, so this can be a 1-factor model, this can be a 10-factor model. The APT doesn't care. There is a 1-factor APT, a 10-factor APT. Conceptually, you could make a 100-factor, 1,000-factor APT, whatever you want. Yeah. So the condition is simply that we can identify, we can have a factor model, and this factor model accurately describes security returns. This is the first condition. So if you think about this condition and whether it's relevant or it's like justified or not, you could probably argue that factor models do not perfectly describe returns. Okay, they are always also kind of simplifications. But they are also not super bad. If you have a 3, 4, 5 factor model, I mean, the way how these models can describe returns is not too bad typically. The second idea / assumption is that there are sufficient securities in the market so that idiosyncratic firm-specific risk can be completely diversified away. So that's the assumption too. And if you think about that, yeah, I mean, that seems relatively justified, right? I mean, there are a lot of securities, tens of thousands in reality. So it should be possible to diversify idiosyncratic risk. And the third condition is actually probably the most important condition, and the condition that gave the model its name. It's basically saying that there is no persistence of arbitrage opportunities. So in the APT, we can have arbitrage opportunities, but those arbitrage opportunities will never be persistent. So basically, as soon as an arbitrage opportunity occurs, somebody will trade it and it will disappear very quickly. So there is no persistence in arbitrage opportunities. So what is arbitrage in this model or in this idea? Well, arbitrage has two conditions. Okay? The first condition, I think that is pretty obvious, is a sure profit. So it's only arbitrage if there is a 100% guarantee that you will make this profit. So if you think about that, it seems obvious, but in reality, it's often not so clear. So there are many trades that people sometimes consider as kind of arbitrage, but some of them still involve some residual risk. And like in a model sense, or in the purest form of its definition, as soon as there is some risk, we would not classify this as arbitrage. Okay? So to give you an example about that, consider what is going on in Hong Kong now, since a couple months, a year probably. There are a lot of people actually doing something that is called the carry trade. So because Hong Kong has lower interest rates than the US dollar interest rate, what many people are doing is they are converting Hong Kong dollar into US dollar so that they can get the higher interest rate. This is often perceived as risk-free because there is a peg between the Hong Kong dollar and the US dollar. So basically, you know when you convert your Hong Kong dollar to US dollar today, you know you can also convert them back at basically the same rate in the future. So if you get a higher interest rate in the US than you get in Hong Kong, this seems like very risk-free. But if you think about it carefully, obviously there is still some residual risk, right? Because there is no guarantee that this peg will stay in place forever. So if you do this strategy, if you do this carry trade, you're basically exposed to the risk that the peg will be abolished at some future point of time. I mean, the probability for that is probably not high, but it's also not zero. So whenever we think about something as an arbitrage opportunity, even this residual risk must not exist. It must be completely risk-free. Okay? And the second condition is that it is a zero investment strategy. So arbitrage in the APT sense is really only an opportunity, an investment opportunity that you can realize without investment, and then you make a sure gain. Okay? So the classical example would be you go long in one position and short in the other position, and you take the money from the short selling to fund your long position. So in the model, there is no, it's like frictionless. There is no margin requirements. There is nothing like that. So basically, when you short sell for $100, you can take the $100 and fund a long position of $100. Okay? So hypothetically, consider the same asset has two prices. What you would do is you would short sell the asset with the higher price and go long position in the asset with the lower price. And this would be your arbitrage gain. Okay? So, The APT requires the zero investment condition for a very simple purpose. If there is a zero investment, basically every investor, independently of his or her wealth or even risk aversion, can take infinitely large positions in the arbitrage strategy. Right? Even if you have no equity, even if you have no money, because this arbitrage strategy is a zero investment strategy, you can take an incredibly large position. And because it's sure profit, you also want to take an incredibly large position. So basically, what happens is, if there is an arbitrage opportunity in the market, as soon as only one investor spots it, this one investor will be sufficient to make this arbitrage opportunity go away, because this one investor will take an infinitely large position in this strategy. Okay? So this will be kind of important because this is the pricing condition in the APT, basically, that there is no arbitrage. This is very different if you think about it, or if you look at this slide. This is really very different from the capital asset pricing model, right? In the capital asset pricing model, the whole approach, the idea, the conditions, the assumptions, they were very different from this. The capital asset pricing model basically came from this Markowitz portfolio selection world and then extended this into an equilibrium world, heavily relying conceptually on this inherently unobservable market portfolio. Okay, so that's the CAPM world. The APT is very different. The APT doesn't require Markowitz. The APT has no market portfolio. The APT doesn't talk about optimization of portfolios for individual investors or something like that. It's really only those three very simple ideas. Factor models, no idiosyncratic risk, or enough securities to diversify idiosyncratic risk, and no arbitrage. So it's a very different model, a very different starting point. And if you think about the starting point and the CAPM, it's kind of surprising, and you will see that in probably 20 minutes, that the end result is super similar. Okay, the end result is nearly identical. Or to some degree, we can say that the CAPM is a special form of the APT. Okay, I will talk about that. But important to remember, very different starting point, no market portfolio, no Markowitz, no mean variance optimization, nothing like that. Okay, very different starting point. Factor models, no arbitrage. Good. So let's look at the APT and how that works. So this is a factor model. We talked about that. This is a one-factor model. You could also do a two-factor model. I'll show you later. So what this basically says is that the return of asset P is the expected return of asset P plus some macro shock F, some risk factor F, some macro risk factor F, times beta. So the sensitivity of asset P to that risk factor plus the firm-specific news or shocks of asset P. So remember, factor models always like three components: expected return, systematic risk components, and idiosyncratic risk components, or idiosyncratic shock components and systematic shock components. So this here would be the systematic shocks, factor F, and this here would be the firm-specific shocks. Good. So F can be here really any factor. Think about it as economic growth or GDP growth. So basically, if like the GDP growth is as expected, then F would be 0 and the return would be exactly the expected return plus like a firm-specific shock component. But conceptually, F can be anything, any systematic risk factor. It could also be inflation, it could be interest rate, it could be the oil price, whatever you like. So now let's think about what happens if P is a well-diversified portfolio. So if P is a well-diversified portfolio, what actually happens is that EP will disappear, right? Remember, we already talked about that before. If we add more and more stocks to a portfolio, so if the portfolio becomes well-diversified, then these firm-specific risks, these firm-specific shocks, they tend to cancel out and they approach zero in the well-diversified portfolio. So for a well-diversified portfolio, basically this firm-specific shock component here disappears. Okay? I mean, the idea again is very simple. If you have 10, let's say 1,000 stocks or whatever, I mean, some will have a positive firm-specific surprise on a specific day. Some will have a negative firm-specific surprise on a specific day. But they will, on average, just cancel out. It will be, on average, just zero. Okay? Remember, those firm-specific surprises, and this is kind of the idea of the factor models, they have an expected value of zero, right? Because otherwise they would be part of the expectation. And they are uncorrelated among each other. So the firm-specific surprise of firm 1 is uncorrelated to the firm-specific surprise of firm 2. Because the only thing, if you remember that, the only thing that drives correlation and co-movement in the factor model is actually the common factor F. So all these firm-specific shocks are really completely 100% firm-specific, and that means they are uncorrelated among each others, right? So that's also the reason why if you add more and more and more of them into the portfolio, they tend to cancel out. Is that 100% realistic? Well, of course not, right? I mean, in reality, it's not so easy to say something is 100% uncorrelated or something. But conceptually, I think it's still very clear, the idea. So we have a common factor, a common risk factor, the systematic risk factor, and we have purely firm-specific risk factors, purely firm-specific shocks. Good. So if we have a well-diversified portfolio, basically EP disappears. So that's the important message. So what is then the expected return on such a well-diversified portfolio? Well, because there is basically no idiosyncratic risk in the well-diversified portfolio, right? Because that's all diversified away. The only risk, if you think about that, the only risk that is left in the portfolio is the macro risk factor, the systematic risk factor, okay, because that disappeared. So then kind of intuitively, it's clear that the idiosyncratic risk should not be compensated in terms of higher expected return. So if a specific stock like has a very high firm-specific risk, I mean, why should you get a higher expected return? You can simply diversify that away, okay? The only thing that justifies a risk premium in terms of higher expected return is actually systematic risk, F, the macro risk factor, because that cannot be easily diversified away, or it cannot be diversified away at all, probably, okay? So to put things even simpler, in a well-diversified portfolio, there is no firm-specific risk, so obviously there is no risk compensation for firm-specific risk. The only risk that a well-diversified portfolio has is systematic risk, okay? And of course, systematic risk should be compensated. So let's look at that, especially the difference between a well-diversified portfolio and a single stock. So assume there are two assets. One is a well-diversified portfolio, let's call it A, and one is a single stock that we call S, so A and S. Both have the same expected return of 10%. So if there is no macro surprise, if there is like GDP growth is as expected, if you want, no macro surprise, both get a return of 10%. But of course, if the macro surprise, GDP growth as an example, is higher or lower than expected, then the realized return will be higher or lower than this expected return of 10%. It kind of looks like this. So this is the realization of the macro risk factor, and this is the actual return. So if there is no surprise, if F is basically 0 because GDP growth is as expected, then the return is exactly 10%. But if F is, let's say, much higher than expected, the return will be higher. And if F is much lower than expected, the return will be lower. So remember, this is basically, the slope of this line is beta, right? The slope of this line tells us how sensitive the stock is to the macro risk factor. So if beta is very high, the stock is very sensitive. If beta in the extreme case is 0, it's a flat line, and there is no sensitivity of the stock to the macro risk factor. Yeah? Clear? So the same thing, the same blue line basically exists for a single stock. So this is the single stock, this is the well-diversified portfolio. What is the difference between the single stock and the well-diversified portfolio? Well, this well-diversified portfolio has no firm-specific risk, right? That means the actual return of the well-diversified portfolio is completely determined by the realization of F. So if F is high, we know exactly what return we get. If F is low, we know exactly what return we get, right? Because remember, this is the factor model. The return is the expected return plus the sensitivity, which we know, times the realization of the macro factor. And EP is 0 for the well-diversified portfolio. So everything is on this blue line. The macro risk factor is the only thing that determines the actual realized return. If you look at the individual stock, this is different. Because for the individual stock, let's go back, EP obviously is not 0. For the individual stock, EP can be high or low. There can be positive firm-specific surprise because, I don't know, the firm makes a technological breakthrough, or there can be a negative firm-specific surprise because somebody steals some business secrets, whatever you want. So if F is high, so GDP growth is higher than expected, I mean, on average, this single stock will also have a high return. But how high exactly? Well, we don't know, right? Because it could be that there is a positive firm-specific surprise, a negative firm-specific surprise. So basically, the realizations are scattered somewhere around this blue line. And the difference between the blue line and the actual realization, the black dots, this is the firm-specific shock. So on some days you have positive firm-specific shock, some days you have negative firm-specific shock. So this difference will be very important for the APT, because as you will see in a second, the APT, and that's probably the biggest disadvantage of the APT, in its core, the APT doesn't work for individual risky assets. It does not work. It doesn't apply to our single stock S. In its core, the APT is a model for well-diversified portfolios. So later we will basically try to think if we can still apply it to single stocks, and the answer will be kind of, but it's not in its core a model that can be used for pricing single stocks. It's a model that is focusing on well-diversified portfolios, which is very different from the capital asset pricing model, because this model is explicitly focusing on individual securities. If you remember, we thought, well, there's a new stock, and what must the return be so that it is included in the market portfolio? CAPM, individual securities. APT, well-diversified portfolios. Okay? So why is this model only applying in its core to well-diversified portfolios? Well, let's look at what the model actually does. So we are not formally developing the model in terms of formulas or math, but we are just looking at the intuition. But I think then things become very clear. Yeah? So we have our well-diversified portfolio A. Okay, this portfolio A has some positive beta and an expected return of 10%. So what would happen if there is a second well-diversified portfolio, let's call it B, that has the same beta than A and an expected return of 8%? So it's actually the same as portfolio A, but it has a lower expected return. Yeah? So what happens? Well, the slope of this line is the same, right? Because the slope is defined by beta, so beta is the same for A and B, so both have the same slope. So the intercept is different because the intercept here is the expected return. So if the macro surprise is 0, you get 10% for A and you get 8% for B. Right? So, can these two portfolios, is it possible that these two portfolios coexist in the market in the APT? So can both of them exist? And remember, the third condition, idea, of the APT was that there is no persistence of arbitrage opportunities. So if this would happen, if these two portfolios would exist at the same time, this would be an arbitrage opportunity. So how can you make an arbitrage profit? Remember, arbitrage, two conditions. 100% certainty, sure gain. Second, no initial investment, no equity, zero investment. So what do? How can we make an arbitrage profit now? Well, pretty obviously, I think you would actually buy portfolio A, yeah, and you would short sell portfolio B. Is that risk-free? Let's say you invest $1 in A, long position, and you short B $1. So same position in A and B. It's zero-sum investment, right? I mean, because you short B for $1, so you get $1, and this is the $1 you invest in A, so it's zero investment, zero initial investment. That's obvious. But is it also risk-free? Long A, short B. And yes, it is risk-free, right? I mean, think about it. The realizations, the returns, and this is what we showed here, are exactly always on this blue line. It's a well-diversified portfolio. There is no firm-specific risk. The macro factor is the only thing that determines the return. There is nothing else. There is no firm-specific risk, nothing else. The realization of the macro factor is the only thing that determines the return. So that is true for A and B. Right? And of course, I mean, you have to, don't think about it too much like in the real world. Think about it from a model perspective. I mean, this is assuming that this one factor model perfectly describes returns. Yeah, this is the assumption. Do we buy that? Yeah, probably not 100% in reality. But if you believe it, like this one factor model perfectly describes returns, then all the returns are always on these lines. So if the macro surprise is 0, you get 8% here and 10% here. If the macro surprise is like this, you get exactly this and exactly this here. So there is always a gap of 2%, no matter what the realization of the macro factor is. Because A and B have the same sensitivity to the macro factor, but you take opposite positions in them, one long, one short. So the macro factor, the macro risk factor completely cancels out. Okay? So A and B cannot coexist in the market, at least not over longer term, so because they represent an arbitrage opportunity. You always make 2%, independently of the realization of the macro factor, and this is why this is an arbitrage opportunity. Okay? So, why does the APT not apply to single stocks? Let's assume for a second that A and B are single stocks. It's not a well-diversified portfolio, it's just two single stocks. They have the same betas, 10 and 8% expected return. Okay, so the only change I make mentally is that it's not a well-diversified portfolio anymore, it's a single stock now. Would there still be an arbitrage opportunity if A and B would be single stocks? Right. It's not an arbitrage, right? Because if the macro realization is 0, yeah, it could still be that B has a very high firm-specific surprise and A has a low firm-specific surprise. So you don't know. The macro risk factor cancels out. Yes, but the firm-specific risk factor doesn't cancel out if those are two individual stocks. So it's not risk-free. There could be a world where you actually long A, short B, but you still make a lot of loss. Because you are long A, let's say A has a very negative firm-specific surprise. So you make a lot of losses. So if these would be single assets, actually they could coexist like this. There is no arbitrage opportunity. And this is why single assets are not basically what the APT is talking about, because its whole idea doesn't work for them. This no arbitrage condition that we just kind of talked about only applies to well-diversified portfolios. Good. So, two assets, two well-diversified portfolios that have the same factor sensitivity beta, they must have the same expected return. That is what we just saw. Otherwise, there is an arbitrage opportunity. But what about two well-diversified portfolios that have different betas? Can they have different expected returns? And the answer is yes, of course, right? Because beta measures basically how sensitive this asset is to the macro factor and how high the systematic risk of that well-diversified portfolio is. So let's say we have the same asset A that we had before, 10% expected return. Let's say its beta is 1. Yeah? And then let's say we have a risk-free asset that we call F that has an expected return of 4%. Beta obviously 0. Okay? So what is now the expected return of a well-diversified portfolio that has a beta of 0.5? Could it be 6% like C? Is that possible? Well, no, right? Because then again, we would have an arbitrage opportunity. If the expected return of a well-diversified portfolio with a beta of 0.5 would be 6%, there would be an arbitrage opportunity. Why? Well, because we could combine F and A so that the resulting portfolio again has a beta of 0.5. So that means, A has a beta of 1 and F has a beta of 0. We just invest 50-50. So the resulting portfolio D will have a beta of 0.5. What is the expected return if you combine 4% and 10%, 50-50? Well, 7%, obviously. So we can create portfolio D simply by combining A and F, and D has 7%. C has 6%. So again, we have a problem. This cannot be equilibrium. There's an arbitrage opportunity. So we could go long D, short C, and make a profit. And just to be clear, I mean, in the APT, those situations can happen very shortly, but then even only one investor would take an infinite position in that trade, long D, short C. So there would be a lot of buying pressure on D and a lot of selling pressure on C. So prices would adjust, and the arbitrage opportunity would very quickly go away. Okay? So the only way that a portfolio that has a beta of 0.5, the only way that does not create an arbitrage opportunity is if this portfolio has an expected return of 7%. If it is higher than 7%, arbitrage opportunity. Lower than 7%, arbitrage opportunity. Okay. And that same idea is true for all the other betas too. I mean, if you have a beta with if you have a well-diversified portfolio with a beta of 0.75, it must also be on the blue line. If it would be below or if it would be above, you could combine F and A so that you are on the blue line. And then again, we would have two portfolios with the same beta that have two expected returns, which is not possible. Okay? So basically, the beta expected return relationship must be this linear relationship shown by this blue line. If it's not the case, if this would not be the case, if there would be any portfolio for any beta that is not on the blue line, here or 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 here, you will always be able to find an arbitrage strategy. Right? Because then you can combine F and A so that it has the same beta as the portfolio that is not on the blue line. Then you go long in the one and short in the other, and you have arbitrage. Okay? Is that clear? So, and what you see here, this blue line, this, I hope, reminds you of what? One of the most famous equations in finance, the security market line in the CAPM. Right? This is very similar to the security market line in the CAPM. So the security market line equation is expected return is risk-free rate plus beta times market risk premium. That's the CAPM world. And this equation describes this linear relationship between the expected return and systematic risk. That's the core result of the CAPM. And the same thing we have here. This is systematic risk, this is beta, and this is expected return, and we have a linear relationship. Very similar to the capital asset pricing model. Of course, I mean, here it's like very general. It's just saying it to a macro factor. This could be anything. But if you think about that, and if you replace macro factor by market risk, so if A is the market portfolio, then actually what this is exactly the same as the capital asset pricing model. So to some degree, if you have a one-factor security market line, so if we, a one-factor APT, if we assume that the risk factor is the overall market, then the APT, or at least the outcome of the APT, is equivalent to the outcome of the capital asset pricing model. Why? Well, because then expected return is risk-free rate plus market risk premium times beta. Because if this is the market, so then this is the market risk premium here, this is 1, and this is beta. It's exactly the security market line equation. Exactly the same as the CAPM. But to some, if you think only about the outcome, I mean, the APT is more general, because the CAPM always assumes that the market is the systematic risk factor, right? The market portfolio, that's also the problem of the CAPM. The APT is silent about what the macro factor actually is. It could be anything. And the APT can also be extended in a multi-factor APT, so where you have different sources of systematic risk, not only one source. But it's still quite remarkable, I think, that we end up with the same equation as in the capital asset pricing model, although we started from a very, very different angle. There is no Markowitz, there is no individual portfolio optimization, mean variance optimization. There is no market portfolio in the APT when we develop it, right? Only 3 conditions. 3 conditions. Factor models describe returns, enough securities to diversify idiosyncratic risk, and no arbitrage. At least no persistence of arbitrage. Most importantly, we kind of get rid of the most annoying thing about the capital asset pricing model, and this is this market portfolio. Remember, we said we don't like the market portfolio because it's inherently unobservable. Theoretically, it's nice, but in practical terms, it's like really annoying. I mean, we know we cannot see it because it's everything. And this market portfolio creates real issues for the CAPM because if you also remember, we talked about these tests of the CAPM, and we said there are basically 2 tests of the capital asset pricing model. The first test relies on the market portfolio and tests whether this is the most efficient portfolio, essentially. And the second test relies on the security market line and checks whether, like, returns are really increase in systematic risk. The first test we cannot do, we cannot observe the market portfolio, so we only rely on the second test. But the second test has problems, as Roll, for example, pointed out, and it's basically not a very nice test of the CAPM. So in some sense, the CAPM cannot be tested because we don't observe the market portfolio. The APT doesn't require a market portfolio, so it's a very big advantage. So this is just a graphical illustration. This is the security market line as exactly as we had it in the CAPM. So that's basically the APT. Is that clear? Questions? So very simple. I mean, the only thing, no arbitrage conditions. The only thing you have to remember basically is, you have to remember a bit more, but the conceptual key is really that 2 well-diversified portfolios with the same beta, they must have the same expected return, otherwise arbitrage. There must be a linear relationship between expected return and beta, otherwise arbitrage, right? Those are the 2 things. This is really the core. So what about individual risky assets and the APT? Well, as you have seen, the APT applies to well-diversified portfolios, not necessarily to individual risky assets like stocks. So for well-diversified portfolios, the expected returns must be proportional to beta. This is the APT. Single securities. Well, people have shown that this APT relationship, this linear relationship between beta and expected returns, that must also hold for the vast majority of securities. People showed that. The proof of that is not easy. The intuition is that if too many securities, individual securities, would violate this condition, it wouldn't be possible that all well-diversified portfolios fulfill the condition. Right? I mean, imagine a world where all individual securities violate this linear relationship beta expected return condition. How is it then possible that all well-diversified portfolios follow this condition? It wouldn't be possible, right? So people have shown that the majority, the vast majority of individual risky assets must also follow this equation, this linear relationship. Otherwise, it wouldn't be possible that all well-diversified portfolios follow this linear relationship. But it is still possible in the APT that at least some individual securities do not follow this linear relationship. So they are not on the security market line. So it's very well possible that we find that some individual assets, some stocks, some bonds, whatever, they are not on the security market line. That we cannot exclude. This possibility we cannot exclude in the APT. So in other words, if you spot that an individual risky asset is not on the security market line in the APT world, you don't know if that is mispricing or not. It could be fine because the individual risky asset doesn't always have to follow this condition. Okay? So APT and CAPM, yeah, I've already talked about that a bit. Very different starting point, basically no arbitrage. We have no market portfolio in the APT. So the biggest strength of the APT compared to the CAPM, I think, would be that the APT does not require the market portfolio. Like the whole model is very slim, very clear. No market portfolio, simple, no arbitrage conditions. The biggest disadvantage of the APT surely is that it only applies to well-diversified portfolios. Okay? And to a smaller extent also that the model itself does not give us clear guidance on what the factor actually is. It's just a macro risk factor. But what should that be? I mean, the CAPM is clearer about that. So CAPM, very different model coming from this mean variance optimization, coming from Markowitz. Equilibrium is like restored because many individual investors trade. And most importantly, and this is the biggest advantage of the CAPM, it describes equilibrium. It applies to all assets. Well-diversified portfolios, individual assets, everything. Biggest disadvantage, kind of the contrary to the APT, is like it's the model itself is rests on this market portfolio, which makes it a bit hard, very hard to test, and also people don't like it so much that the market portfolio is such an important part of the CAPM. Although we know it doesn't, it's inherently unobservable. Okay. But to end the first part on a positive note, it's remarkable and I hope reassuring that both models come from very different angles and they end up with basically the same message. Expected return is a linear function in systematic risk. That's the message of both models. So this is something that should add confidence to us when we apply the security market line equation, basically, because we now know that there are two models that end up with the same equation. Okay, so let's have the first break, 10 minutes break. Okay, let us continue with the second part for today. Yeah, so we talked about the APT now, and for simplicity here, I only showed you a one-factor APT. So remember, one-factor APT means one systematic risk factor, one macro shock. But you can very easily extend this to a multi-factor APT. So this is a two-factor example, the two-factor model, the return, again, expected return, plus the firm-specific shock components. But now the macro shock or the macro news shocks are basically divided in two parts. Macro shock 1 times sensitivity to macro shock 1 plus macro shock 2 times sensitivity to macro shock 2. So if you remember, this is directly going back to the multi-factor models that we discussed in the last lecture. And this two-factor model is actually very similar to the one-factor model. And the two-factor model can very easily be extended to n-factor models. Okay? So a little bit later, we will actually discuss how we can identify the factors that we should include. But conceptually, from a model perspective, I mean, it really doesn't matter. You can extend this to n factors. Good. So in a multi-factor APT, actually also in a single-factor APT, but it's clearer to see in a multi-factor APT, we do have so-called factor portfolios. And factor portfolios are well-diversified portfolios that have a beta of 1 to 1 systematic risk factor and a beta of 0 to all other risk factors. Okay? So if you want, the market portfolio is also a factor portfolio because it has an exposure of 1 to the market risk factor and an exposure of 0 to all other risk factors. But the second part is a bit silly because obviously in the CAPM or in the one factor APT, there is no other risk factor. Okay? But it's not too different conceptually. So the factor portfolio tracks a particular source of macro risk, but it is completely uncorrelated with other risk sources. Okay? So let's say one macro risk factor is GDP growth. So if we identify a portfolio that has a sensitivity of 1 to GDP growth news and a sensitivity of 0 to all other factors, we would call this the factor portfolio, okay, for this specific factor. If there are many securities in the universe, as it is the case in reality and also in the APT model world, those factor portfolios exist and they can be constructed for all factors. However, as I will also show you in a second, this can be a bit tricky because, I mean, if you think about the task of identifying a portfolio that has a sensitivity of exactly 1 to one factor and exactly 0 to all other factors, this is not always trivial. I will show you in the example that we do in a second that actually in practice those pure factor portfolios, we don't even need them most of the time. What we use factor portfolios for is actually to calculate factor-specific risk premiums, right? Like the market risk premium in the CAPM. The market portfolio, think about it as a factor portfolio. So how do we calculate the market risk premium in the CAPM? Well, we take the expected return of the market portfolio and subtract the risk-free rate. How do we calculate the risk premium for GDP growth risk? Well, same idea. We take the factor portfolio for GDP risk, the expected return of that portfolio, and subtract the risk-free rate. That's the risk premium for GDP growth risk. And let's say inflation risk is another macro risk factor in our two-factor model. Then we take the factor portfolio for inflation risk, so the portfolio that tracks inflation risk, that has a beta of 1 to inflation news and a beta of 0 to the other risk factor, GDP growth. So and then we calculate, we take the expected return of that portfolio, beta of 1 to inflation news, beta of 0 to GDP news, subtract the risk-free rate, and then this is the risk premium for inflation risk. Okay? So this is how we typically think about calculating factor-specific risk premiums. But don't get confused, it's very simple. It's basically the same as the market risk premium. Market portfolio minus risk-free rate. Market portfolio beta of 1 to market risk, and implicitly a beta of 0 to all other risk factors, but in the CAPM there are no other risk factors. Right? I will show you that we don't need these pure factor portfolios to calculate factor-specific risk premiums. We will actually be able to use any correctly priced portfolios to do that. Okay? Good. Beta of portfolios, this is really same as for CAPM. If you combine individual assets into portfolios, then the beta of the portfolio is actually just the weighted average of the betas of the individual risky assets. Okay, so very simple. I think that is clear. Let's look at an example, very simple one. Let's say there are two pure factor portfolios for now. We will remove them in a second, but let's say they exist here. So we just call the factors 1 and 2. So the expected return on the pure factor portfolio for factor 1 is 10% and 12% for factor 2. Risk-free rate is 4%, so the risk premiums are 6 and 8%. Okay? So now consider a well-diversified portfolio A, beta on the first factor 0.5, beta on the second factor 0.75. So what is the expected return on A? Well, we know the expected return is, this is basically the security market line equation, right? It's the risk-free rate plus compensation for systematic risk. So the risk-free rate plus sensitivity to the first systematic risk factor, 0.5, times the risk premium for the first systematic risk factor, which is 10 minus 4, 6%, plus sensitivity to second systematic risk factor times risk premium for second risk factor. So we get 13%. And you can extend this to n factors, right? I mean, for every factor, you have this component, sensitivity times risk premium. If you have a one-factor model, you have risk-free rate plus one of these components, sensitivity times risk premium. If you have a two-factor model, you have this 2 times. If you have a 10-factor model, you have this 10 times. Nothing conceptually changes. It's always basically the security market line equation. Basically, yeah, okay? So nothing changes. So think about it as risk-free rate plus compensation for factor risk, or for systematic risk, if you want. Yeah, so this is just, I mean, we don't do that. I mean, you just replace the betas here and then you can calculate the expected returns. Okay, so that's too trivial. So what would happen now if the expected return on A would be 12% and not 13%? Or in other words, why is it necessary that the expected return of A is 13% in a world without arbitrage? Well, let's look at it. Let's say it's 12. So we know that all portfolios with the same factor risk must earn the same expected return. So let's now try to form a new portfolio that has the same factor risk as A. Right? I mean, whenever we do arbitrage, we need to have a portfolio that has the same factor risk, because only then we can eliminate factor risk. Right? I mean, if you have two portfolios that have the same factor sensitivities, you can go long in one and short in the other, and factor risk is gone. Okay? So how do we do that? Well, we simply combine our two pure factor portfolios here, 1 and 2, so that the resulting portfolio has the same betas as A. Okay? So we combine the two pure factor portfolios in a way that the resulting portfolio, which we call Q, has the same betas as A. So what was the beta of A? It was 0.5 on factor 1 and 0.75 on factor 2. Right? So how do we do that now? Well, with the pure factor portfolios, it's pretty simple. We just invest half of our money in factor portfolio 1, 0.5 of our money in factor portfolio 1. The beta of factor portfolio 1 for factor 1 is 1. So if we invest 0.5, we get a beta of 0.5. And because it's the pure factor portfolio, it has a beta of 0 to the second factor, so we don't have to care about that. So what we do is actually we invest 0.5 in the first factor portfolio of our wealth, 50%. We invest 75% of our wealth in the second factor portfolio. And this exactly replicates the betas of 0.5 and 0.75. So this new portfolio Q now has exactly the same betas as A. So what is the expected return on Q? Well, that's very easy. I mean, the expected return is the expected return on the first factor portfolio times the amount or the fraction we invest in it, plus the expected return on the second pure factor portfolio times our investment in it, plus the risk-free rate times our investment in it. And how much do we invest in the risk-free rate? Well, 1 minus the fractions we invest in the pure factor portfolios. So basically that is a negative number, which means we borrow money if you want. Okay? So then you can restate that, but that is all not super, I mean, it's not difficult. So then the expected return is, of course, 13%. So now we have two portfolios. Portfolio A, for which we know for some reason that the expected return is 12%. And portfolio Q, which is a combination of the two pure factor portfolios. They have the same factor risk, same betas. A has 12% expected return, Q has 13% expected return. What is the arbitrage strategy? Well, very simple. Q has a higher return than A, but the same factor risk. So we go long in Q and short in A. Two conditions for arbitrage. No investment, risk-free. Right? No investment, yes. I mean, we invest $1 in Q and short $1 in A. So basically, remember, this is no margin account, nothing like that. I mean, it's frictionless. So we basically take this $1 from shorting A and invest it in Q. No investment. Is this risk-free? Yes, right? They have the same factor risk exposure. And we are long in one and short in the other. So the factor risk, the systematic risk, completely cancels out. There is no risk. One has a sensitivity of 0.5. Our long position here has a sensitivity of 0.5 to the first factor. So if the first factor is unexpectedly high, let's say it goes up 5%. Our second position has a sensitivity of minus 0.5 to the first factor because we have short position. So if the factor goes up 5%, we go down 5%. If the factor goes up, this goes down 5%. So the movements of A and Q always counter each other. No matter what the realization of the systematic risk factor is, there will always be this 1% difference between the return of A and Q, 13 minus 12, independently of the realization of the macro risk factor. Remember, this is this picture. Yeah? No matter where you are, if you're long A, short B, it's always the same difference. The systematic risk cancels out. So what's the profit? Well, if you invest $1 and the difference in returns is 1%, it's obviously 1 cent. Right? But remember, zero investment, zero risk. So actually, every investor who spots this opportunity has an incentive and opportunity to take a basically infinitely large position in this strategy. There is no initial investment, no risk. So you wouldn't play that with $1, you would play that strategy with $1 million, or $1 billion, or $1 trillion, or $100 trillion, or whatever you want. And because of that, if only one investor or a very limited number of investors spots this mispricing, this opportunity, the opportunity will disappear quickly. Right? It doesn't need all investors to be aware of this investment opportunity. If only one or very few investors are aware of it, they will trade this opportunity with very large quantities of money because risk-free and no investment, so that this opportunity will disappear quickly. Good. So what happens, this is what I told you, this is what happens if there are no pure factor portfolios, or if we cannot identify that. Because of course, in reality, if you just look at random portfolios, they will never have a sensitivity of exactly 1 to 1 factor and exactly 0 to the other factor. Even less so if you have a 5-factor APT. I mean, realistically, the vast majority of portfolios, virtually all portfolios, have a sensitivity, a non-zero sensitivity to the different risk factors. Okay? So theoretically, it is always possible to find these pure factor portfolios, but this can be pretty tricky. And we don't need it. As long as we have a sufficient number of correctly priced, well-diversified portfolios, we don't need pure factor portfolios to calculate the factor risk premium. Okay, it's not necessary. Why? Well, let's say there are 2 correctly priced portfolios. So we know B and C correctly priced. We know their expected returns 23 and 20, sensitivities 0.5 and 2, and 2 and 0.5. Okay? So what do we know for correctly priced portfolios? Well, we know that the expected return is what? Risk-free rate plus compensation for systematic risk. So this is always the beta times the risk premium, beta times the risk premium. So what we essentially have now is 2 portfolios, and we can set in the values of those 2 portfolios in this equation. So then we have 2 equations, and we have 2 unknowns. So 23% equals the risk-free rate, which I think was 4% or so, plus beta 0.5 times risk premium plus 2 times risk premium. So we do that for the second portfolio. So then we have 2 equations, and the 2 unknowns are RP1 and RP2. And as you know, obviously, if we have 2 equations for 2 unknowns, we can solve the problem. Right? So we can solve for RP1 and RP2, substitution elimination method, and then we can find RP1 and RP2. Okay? So how do I do that? I mean, it's very simple, just for completeness here. So we know that. This is because we know that this is portfolio B and this is portfolio C. We know that they are correctly priced. So this is what we know. So these equations must hold. So what we want to do now is we want to save these equations, to solve these equations for RP1 or RP2. Okay, how do we do that? Well, elimination or substitution method. Let's do elimination here. If you want to do elimination, you always try to manipulate one of the equations so that the unknowns RP1 or RP2 is the same in both equations. So what we basically do is we multiply the second equation times 4, every aspect. So we get 80, 20 becomes 80, 4 becomes 16, and so on, and 2 RP2. So now we have 2 RP2 in equation 1 and 2 RP2 in equation 2. So because of that, we can now subtract one from the other. So we subtract the first from the second. So we have 80, this one, minus 23, 57, and so on. And because we have 2 RP2 in both equations, magically RP2 disappears. We are back at one equation, one unknown, and then it's super simple. We have 6%. And if we have 1, I mean, then it's trivial. Just take any of these two equations, put 6% in there, and solve for RP2. Okay? So this obviously also works if you have a 5-factor APT. But if you have a 5-factor APT, you need to have 5 correctly priced portfolios. So you need to have as many correctly priced portfolios as you want to solve, as you want to calculate risk premiums. Okay? So the whole point here is pure factor portfolios, they are not really necessary to calculate risk premiums, factor risk premiums. We can use any correctly priced portfolios to do that. And same idea, you can also use all other correctly priced portfolios to implement arbitrage strategies. So also for arbitrage strategies, we do not need to have pure factor portfolios. Of course, it's a bit more messy and more tricky to construct a new portfolio from 2 portfolios that have non-zero sensitivities to multiple factors. It's easier to use the pure factor portfolios. But it's not necessary to use the pure factor portfolios. We can use portfolio B and C to construct a portfolio that we want. Okay? So pure factor portfolio is not really necessary. That's the big message here. Clear? So what are the factors? And it's really kind of, there is no really, so what are the factors? How many factors should you use? And what are the factors, the systematic risk factors that you should use? The APT, unfortunately, does not give us any guidance on that. The APT is a model that really doesn't care about it. It just says, look, there is an n factor model, and then this happens. But what the factors are, what n is, we don't know from the model. So people came up with like 2 principles of identifying these factors that we should always keep in mind and follow. The first is there should be a limited amount of factors, a limited number of factors. If we have too many factors, we run into the problem of overfitting. So in the sense that, of course, if you have a 100 factor model, I mean, if you apply that to historical returns, it might look very nice. But it's not so clear if that is really the most appropriate model. It'd be things, especially if you estimate things then with real data, you have to estimate 100 betas, and this creates a lot of errors. So typically, a 100 factor model performs worse than like a 2 or 3 factor model. So limited number of risk factors. What is limited? Well, again, this is not totally clear. 100 would be too much. Probably at most 10, but 10 is also already quite high. So probably if people use these models, they often use like 5 or something. 3, 5, 6, something like that. Limited number. And the second principle is that we should only include factors that concern investors so much that they demand a risk premium for them. So these must be factors that cannot be easily hedged and that are of great concern to investors. So if they are exposed to this kind of risk, they demand a risk premium for them. Something, and this is Jen, Roll, and Ross, so they came up with some examples, but this is not totally, people have different opinions, so this is really just a random example. Things like expected inflation. I mean, this is something that investors are very concerned about, and it's something that is definitely not easy to hedge. Okay. So yeah, then other factors, unanticipated inflation, like interest rates, GDP, things like that. Farmer French, they use a different approach. They basically say that like we should use firm characteristics that proxy for systematic risk factors. And they say firm characteristics, especially firm size and market to book, which gave birth to this the Farmer French 3-factor model, but also people are not, also people who disagree about that, okay? So the APT is a very simple model. As you have seen, I mean, it's really not hard to understand. Which factors exactly to use, this is a little bit more tricky, okay? Good. Any questions about APT? So then let's move on to the next part, market efficiency. So in this chapter, this subchapter, we will basically explore the question whether markets are efficient or not. And in order to do that, we first have to define what efficiency means. So the most common way to test whether markets are efficient or not is to test something that is called the efficient markets hypothesis. And the efficient markets hypothesis states that prices fully and instantaneously reflect all available relevant information, which is a pretty strong statement. It's very definite, right? I mean, fully, instantaneously, all available information. So this is the efficient markets hypothesis. So it basically predicts or hypothesizes that there is a quick reflection of new information. So whenever people expect something good will happen in the future, then there is new information about any future development coming to the market. Prices will fully and instantaneously reflect this information. Okay, so for example, if the firm announces that something positive happens in 2 months, let's say the firm announces it will start paying a large dividend in 2 months, then prices would adjust immediately when this new information becomes available, and it would not only adjust in 2 months. Okay, so new information in this hypothesis is, of course, unpredictable, but that is, I think, quite obvious. And this whole efficient markets hypothesis, this whole idea of testing how efficient markets are and whether markets are efficient at all, this was developed in the 60s, going back probably even to the 50s, but then especially in the 60s and 70s. And Eugene Farmer played a very important role in developing tests for the efficient markets hypothesis. Okay, so this is Eugene Farmer. He got the Nobel Prize for economics. It's not the Nobel Prize for this thing that is similar to the Nobel Prize for economists. And one reason why he got the Nobel Prize was that he was a pioneer really in developing tests and ways to test the efficient markets hypothesis. And his research shed a lot of light on whether markets are efficient or not. So this is a very short clip that shows that in which he explains what he actually did.
Okay, so if I were to explain my work, I started back in 1962 working on the general topic is how do prices incorporate new information. It's called the efficient markets hypothesis, but that's it basically. How do prices incorporate new information? So I devised a lot of tests to how you go about doing that. That's one branch of asset pricing for which the award was given. The other one is what we call asset pricing models, which are really stories about how you measure risk and then what is the relation between risk and expected return. So they're basically risk-return stories. So those are the two main branches of asset pricing, which I've been working on for the last 53 years.
Good. So when people tried to test this efficient markets hypothesis, they soon realized that this overall hypothesis is just too big and too large to test. So what they did is they divided the overall hypothesis into three sub-hypotheses. And these three sub-hypotheses, they differ with regard to the type of information that is reflected in the prices. There is a weak form, there's a semi-strong form, and there is a strong form. In the weak form efficient markets hypothesis, the claim is that all historical price information is reflected. Okay? So that would mean, if markets would be weak form efficient, that all trading routes, for example, that are based on past prices, they would not lead to excess returns. So if you observe a stock went up for the past 10 trading days, the weak form efficient markets hypothesis would claim that this information is already priced, and if you trade on this information, you cannot make excess profits. Okay? So weak form, historical price information. Semi-strong form goes one step further, and the semi-strong form claims that actually all public information is priced. All public information. What that would mean is that any trading strategy that is based on any public information would not lead to excess returns. Okay. So this would include trading strategies based on annual report, analyst reports, transaction data, advisory data, whatever. Okay. So if markets would be semi-strong form efficient, these trading strategies, they would not generate excess returns. And then there is a strong form efficient markets hypothesis. And the strong form efficient markets hypothesis claims that all public and private information is priced. So there is no excess returns earned by using any information, even insider information. Okay? So what people then did is they developed a lot of tests to test 1, 2, 3. What do you think? Are markets strong, semi-strong, weak, efficient? Any guess? Who believes markets are strong form efficient? Well, strong form is the most obvious nonsense hypothesis, kind of, right? I mean, markets are not strong form efficient because insider information is not priced, and you can make profits based on insider information. But we will come back to that. Weak form, yes, most evidence points to weak form efficiency. Semi-strong form, yes, also most evidence points to semi-strong form efficiency. But there are some pieces of evidence, momentum effect for weak form, I will get back to that, and some anomalies for semi-strong form that are not completely in line with what these hypotheses predict. Okay, so a lot of evidence actually for weak form and semi-strong form, but also some counter evidence. So the rationale behind the efficient markets hypothesis, I think that is pretty obvious, right? I mean, if there is new information, then people adjust their opinions, there's an unexploited profit opportunity basically. So investors will rush to buy and the price rises to the new equilibrium level. So in an efficient market, all unexploited profit opportunities will be quickly eliminated. So not every investor has to be aware of every security in every situation, as long as there are some who look for these unexploited profit opportunities, these opportunities will quickly be eliminated. Remember what we just talked about in the APT. If arbitrage, as the most extreme case, is possible, people would want to take infinite positions, or in practice, very highly levered positions to trade those strategies. Because of course, in practice, I mean, if you spot an arbitrage opportunity, in reality, you cannot trade it for $1 trillion. I mean, in reality, there are margin accounts, there are limits. It's not like you cannot trade $1 trillion, even on an arbitrage strategy. But you can take highly levered positions. Okay. So, and how have these hypotheses been tested? Well, there have been different tests, but one type of test that was very often used and that proved to be very powerful were so-called event studies. So event studies try to understand how a particular event on a particular date affected the firm's stock price. Okay, so let's say the firm announces that they will start paying a dividend today, and you want to know how did that affect the stock price of the firm. So the naive approach would be to just take the stock's return on that day, but that would be wrong, right? Because we know that stocks have returns, because we know that stock prices go up and down even in the absence of firm-specific news. Remember, like in a factor model, there are two drivers, the macro risk and the firm-specific risk, or the macro news and the firm-specific news. So basically what we want to do to really estimate how a specific event affected the stock price of the firm is we want to get rid of the macro news part, because the macro news part affected all firms on the same day, at the same time. So what we want to calculate is an abnormal return that is because of the event. And that's the difference between the actual return and some proxy for the stock's return if the event would not have occurred. So the actual return minus the return if there wouldn't have been this event. But of course, I mean, we cannot directly observe the counterfactual return in the absence of the event, so we have to calculate it. So one way to do that is the market model approach. So this is basically the one-factor model. So we have the return equals alpha plus the market return times beta, so the sensitivity of the stock to the market return, plus the firm-specific idiosyncratic movement or shock. So what is the excess return or the idiosyncratic shock of the stock on that day? Well, it's the actual return minus, and this is the proxy for the return in the absence of the event. So basically alpha, which is often 0, alpha plus beta times the market return. Yeah? And this is really important. I mean, imagine you have a stock that has a beta of 1. So the whole market goes up 2% on a specific day. So this stock is also expected to go up 2%. So if you would use the 2% actual return as the event return, this would be wrong, yeah, because the 2% return comes from the systematic risk part. It's not the firm-specific news part. So if a stock goes up 2% and the market goes up 2%, beta equals 1. The firm-specific news part would be 0, right? If a stock goes up 1% and the market goes up 2%, beta 1. The firm-specific news part would be minus 1%. Okay? So it's important to control for the systematic news component. Good. So let's look at the evidence. What does the evidence say about market efficiency? There is quite a bit of evidence in favor of market efficiency. So these are the 3 things we will talk about. Let's go through them and then we will talk about it. The most convincing evidence actually in favor of efficient markets, or in favor of the weak and also the semi-strong form efficient markets hypothesis, is actually that investment analysts and mutual funds, they are not able to consistently beat the market. Okay, we know that from a lot of different studies. So people looked at mutual fund performance and they found that on average, they are not only not able to outperform the market, they even underperform the market. So there's one study in the Journal of Finance and they looked at 4,000 mutual funds and they found that the average alpha for those funds was minus 0.5%. So mutual funds, professional investment managers. I mean, what are mutual funds? I mean, these are all actively managed funds. You have guys, people sitting there, and they try to pick stocks and beat the market. Right? They can't, on average at least. Is this in line with efficient markets? Yeah, right, because if markets are semi-strong and weak efficient, well, historical price information is priced, and actually all public information is priced. So if these fund managers do not have access to private information, they will not be able to beat the market. And assuming fund managers don't have access to private information, I mean, it's very much in line with efficient markets. If markets would not be efficient, if not all public information would be priced, it would be very surprising to find that those professional managers who earn a lot of money for picking stocks and doing their work, and they have whole teams helping them to select the best stocks, why should they not be able to beat the market if the market would not be efficient? Basically, the only explanation why they fail to beat the market is that the market is very efficient, that the information is already priced. Okay, so there is a lot of evidence of that. That's called the failure of active management. I mean, that's probably a bit overdramatic, but so what this shows is over a 5-year period, the percentage of funds, actively managed funds, that could not beat the index. US large cap 92%, US mid cap 88%, US small cap 98%. So in the US, basically you can barely find any fund that could beat the index, which is a bit crazy. I mean, if markets are efficient, this is what we would expect. Because if they only look at public information, and if public information is priced, I mean, how would they beat the market? There's just no way. If we look at other countries, actually, it's interesting to see that more funds are able to beat the market, which again probably is in line with this idea that especially developing markets, the markets are not yet that efficient. So in the US, markets seem to be very efficient. Funds are not able to beat the market. In other regions of the world, emerging markets, and for mainly smaller firms, there are more funds that are able to beat the market. But also not a whole lot. Good. So the only strategy that we really know of that can generate excess returns is actually insider information. But it's illegal to trade on this information in most circumstances. But I'll get back to that. So, if the average fund is not able to beat the market, you could argue that, well, probably some funds are able to beat the market, right? And if you could find some funds that are able to consistently beat the market, that would again be evidence against the efficient markets hypothesis, because if these guys do not have access to private information, nobody should be able to consistently beat the market in semi-strong form efficient markets. So what does the evidence say? Look, there is very little persistence. That's actually what the evidence says. So this is deciles, this is return. We rank on in a specific quarter funds according to their performance. So 1 are the best performing funds, the decile of the best performing funds, and 10 is the decile of the worst performing funds. So in a specific quarter, we put every fund in one of these deciles. Okay? So then the blue line shows you the performance of these funds in the ranking quarter. I mean, and that's obvious. I mean, because the best funds are in 1, this is the highest, and the worst funds are in 10, so this is the lowest. This is mechanical, technical correlation. What is interesting about this picture is the dashed black line. The dashed black line shows us the performance of these funds in these deciles in the next quarter. And if you look at that, the funds that were the best performers in the sorting quarter, in the ranking quarter, if we go 1 quarter further, they are just average. Probably a tiny bit, but that's not really an effect. If we look at the worst funds in the ranking quarter, and then we look at their performance in the next quarter, they're just average. Probably slightly lower. There is very, very little evidence of persistence in fund performance. Basically, what the evidence says is that, yeah, you sometimes beat the market, but in the next quarter, you don't beat the market. I mean, of course, I mean, if I randomly choose stocks, sometimes I will beat the market. I mean, it's going to Happy Valley and randomly chooses a horse. I mean, and sometimes your horse will win. I mean, yeah, that doesn't mean you are able to really identify good horses or bad horses. Only if you could go there and win in every consecutive race. I mean, that would be evidence that you really have a skill in doing that. And we don't find that evidence in funds, which is very, very consistent with efficient markets. So this is another way of showing that don't go by past returns. It was a Bloomberg piece. So this is the distribution of 1 year best performing funds a year later. So basically, they looked at the best performing funds, and then they looked at 1 year later, and then they found that the best performing funds were often actually then the worst performing funds a year later, and very few of them stayed in the best performing funds group. It's relatively uniformly distributed. So again, not a lot of persistence. Basically, sometimes, some quarter you're very good, some quarter you're very bad, on average, you're just average. And on average, you're just average is it's not a very good statement. On average, you're simply not able to beat the market, which is very much in line with what you see here. The average alpha is minus 0.5. Okay. Good. And this, but I will only very briefly talk about this now because this will be a big topic next week. This because many people realize that active funds are not able to beat the market, which has a lot of implications for us when we test market efficiency, because it's strong evidence in favor of market efficiency, but of course also for the investment universe. Because if you know that, if you know that actively managed funds have an alpha that is negative, I mean, many people actually decided to stop investing in active strategies, which gave rise to like this incredible growth in ETF and other passive strategies over the past 10 years. But I will show you that in the next week. This is just like an overview on where BlackRock thinks that like there is growth in asset management and active equity is actually zero. So there is no growth in active equity anymore. It's a declining industry. Growth is really in things like ETF, robo-advising, digital advising, smart beta, factor investing, things like that. But active equity in its purest form, how it has been done since many decades at least. Actively managed funds, where you have fund managers selecting stocks, picking stocks. This is pretty much, it's beyond the peak, most likely. Okay. Good. So this is the first piece of evidence. Let's do the second break now, 10 minutes break, and then we continue. Okay, so last part for today. Yeah, we are just talking about market efficiency. And I try to present you some evidence right now in favor of market efficiency. After that, we will look at evidence against market efficiency. So the second kind of evidence that we have in favor of market efficiency is especially the early tests, many of them developed by Eugene Farmer or conducted by Eugene Farmer, show that prices actually quickly reflect publicly available information. So what Eugene Farmer did was he looked at certain events and then tried to link the stock price to these events. And what he found is really that the stock price reacts when the information becomes publicly available and not when the event actually takes place. Okay, so this is taken, this is basically following one of his early papers. So this is time here, time. 0 is day 0. This is the day when the event happened or when the information became public. And the information here is a dividend announcement. So on day 0, the firm announced that they will start to pay a dividend sometime in the future. Okay, so this is 12 days before the announcement, 12 days after the announcement. And this is the abnormal return cumulative over the sample period. Okay? So what Eugene Farmer did is actually he basically collected a lot of firms that announced dividends, and then he looked at all their stock prices. And then this is the average across a large number of different firms that announced dividends, and he standardized the announcement day always as day 0. So what we find, or what he finds, is actually that before the dividend announcement day, the stock price is relatively flat. On the dividend announcement day, the stock price goes up a lot, like 5%, and then it's relatively flat again. Okay? So this is very much in line with semi-strong form efficient markets hypothesis. The market price, the price, reflects this new information at the moment when this new information becomes available. Okay? So when people did similar things with other events like M&A announcements or all different kinds of events, and at least the early evidence always pointed to this pattern that the price reacts as soon as the information becomes publicly available. Okay? Good. So I will later show you that newer evidence is a little bit less sure about that, but I'll get back to that in a second. So the third piece of evidence that we have in favor of efficient markets hypothesis is that stock prices are really very hard to predict and more or less follow random walk behavior. So there are a lot of formal tests to do that. And most of these tests tend to show that stock prices more or less follow random walks, or at least they are highly unpredictable. There is a thought experiment. You can think about it. What would happen if stock prices would be predictable? So let's say you are a two-period world and assume for a second that stock prices are predictable. There's a two-period world, period 1, period 2, and you can predict in period 1 what the stock price in period 2 will be. What would happen is that people would trade in period 1. If they predict stock price will go up, they will buy. If they predict stock price will go down, they will sell. So basically all trading would take place now in period 1, and in period 2 there would be close to zero trading because people had already predicted whether the price would be high or low, so they have no reason to trade in period 2. So all stock price changes would actually happen today and not in the second period. This would mean that stock prices shouldn't be very volatile, because people predict the stock price and then they trade and then it's a kind of like no trade anymore, which is not what we see in reality because stock prices fluctuate a lot, indicating that they are at least not highly predictable. So this is a bit of a weak argument, to be honest. I mean, you could find counter arguments to that. It's more a thought experiment, but there are more formal tests on the predictability of stock prices. And also these formal tests tend to reject the idea that stock prices are predictable. Okay? So there is actually quite a lot of evidence in favor of semi-strong and weak form efficient markets hypothesis. I just show you a bit. It's not all. And I'm also not showing you every piece of evidence against the market, against the efficient markets hypothesis. Rather, I try to highlight some of the more important pieces of evidence. Okay? So what evidence do we have against the weak form efficient markets hypothesis? There is something called the momentum effect. The momentum effect means that good or bad performance of stocks tends to continue over the short to medium time horizon. So there is some sort of serial correlation in the performance of stocks. Okay? If this is true, and if we would be able to find profitable trading strategies that generate excess returns based on this momentum, this would obviously violate the weak form efficient markets hypothesis, because this hypothesis predicts that you cannot generate excess returns based on past trading data. Right? If people try to do that, if people try to make a trading strategy based on momentum, they found that for single stocks, it doesn't work very well. But it works reasonably well for portfolios of stocks. So basically what you do is you go long in the 10% of best performing stocks, and you sometimes also then take a short position in the 10% of worst performing stocks. And this strategy has been shown to at least sometimes generate excess returns, which is not in line with weak form efficient markets hypothesis. And this is not only something that people wrote papers about, this is also something that people actually trade. So this is AQR, and what AQR has is a so-called large cap momentum style fund. Not only AQR, it's just a random example. So what is their investment approach? They say, we invest in stocks of large and mid-cap US companies with positive momentum. A stock is considered to have positive momentum if it has performed well in the prior 12 months relative to other stocks in the investment universe. So they actively trade the strategy of buying past winners, if you want, buying stocks with a positive momentum. Problematic for weak form efficiency. Most evidence we have, again, supports weak form efficiency. This momentum effect is a bit problematic. Then there is a second effect that is called the mean reversion effect. The mean reversion effect is the opposite of the momentum effect. It says that over long time horizons, actually things reverse. Past winners become future losers, and past losers become future winners. So there is a reversal. That's basically a negative serial correlation that happens over long time horizons. So this is short, probably medium, mostly short. This is long time horizons. But this mean reversion effect is actually quite weak. So there is some evidence, but new data is not very conclusive. So maybe that doesn't really exist, or at least it doesn't really allow you to generate excess returns. Also, if you look at what is traded, I mean, momentum is much more traded than mean reversion. So mean reversion is kind of okay. I mean, it's pretty weak. Momentum is a bit challenging. Okay? So this is pretty much the evidence we have against against weak form efficient markets hypothesis. If we move to the semi-strong form, we can observe certain anomalies that are also not in line with a semi-strong form efficient market. And one of these anomalies is the so-called small firm effect. So small firms, and there is very consistent evidence on that, have earned abnormally high returns over the past decades. Okay? It's a bit lower in recent years, but it still exists, and it is still a challenge to efficient markets theories. So people proposed a lot of different explanations for it, but none has come out as like the explanation that all people believe is the true one. So what we basically see is a pattern like this. So this is sorting firms into size deciles. Here, plotting returns, long time series, 26 to 2008. So small firms have a much higher return historically than large firms, like 20% versus 10. So 9% something difference. Okay? And importantly, this is not explained by higher systematic risk of small firms. So higher systematic risk of small firms cannot explain this pattern. So why is this pattern evidence against the semi-strong form efficient markets hypothesis? And you could say, yeah, this pattern exists, but markets could still be efficient. But no, actually not. This is a well-documented and well-known fact and finding that small firms outperform large firms. This is clearly public information. In semi-strong form efficient markets, we would expect that this information, firm size, is priced. But it seems firm size is not priced. And this is very surprising. So in efficient markets, what we would expect to happen, this is public information. So people would rush to the market, buy small firms and sell large firms so that the price of small firm goes up, their returns go down, and the opposite happens for large firms until basically we have a flat relationship. But that we are not seeing happening, at least, I mean, this effect diminished a little bit, but it's still not zero. Okay. So this is a bit challenging for efficient markets theories. Okay. A similar thing exists for the book-to-market ratio, but I will not really talk about that now. Important is just to remember small firm effect. Small firms outperform large firms. This is not explained by systematic risk differences. And it is unclear why this public information, firm size, is not reflected fully in the price. Theories exist, but none of those theories has come out as the universal explanation. Somewhat related is the so-called January effect. Okay, the January effect is the tendency of stock prices to have abnormal positive returns in January. The interesting thing about this January effect is that we have a pretty clear understanding why this effect exists in the first place. And this is for tax reasons. In many jurisdictions, the tax cutoff date is end of December. In Hong Kong it's different, but in many jurisdictions, the tax cutoff date is end of December. So actually in December, many investors, especially retail investors, they have incentives to sell their stock if they made losses on their stocks, because then they can deduct these losses from their tax liabilities, or at least from their income. So what many retail investors then do is they sell their stocks in December, they realize their losses, and then in January they buy the stock back, which creates an abnormally high buying pressure for stocks in the month of January. So that is kind of why this effect exists in the first place. What is surprising about all of this is that this effect is not traded away. This is public information. So in fully efficient markets, semi-strong form, we would expect that some investors step in, like hedge funds or whoever, and they trade to profit from this January effect, so that the January effect then ultimately disappears. But this does not seem to happen. Okay? This does not seem to happen, at least probably it happens, but it is not happening in a scale that is large enough to make this effect fully go away. Again, the reason why this thing exists is related to taxes, so that's fine. But in efficient markets, we would expect this effect to disappear because people trade based on this information, based on the fact that there is abnormally high returns in January. And this return is predictable. And if enough people would trade this strategy, this January effect should actually disappear, which it doesn't. Okay? So these are two anomalies, small firm effect and January effect. And related to something I showed you before, this was that new information is immediately reflected when it comes to the market, Eugene Farmer's early studies. More recent studies are not so sure about that. New information is not always immediately incorporated into stock prices, especially for profit announcements. So there is something, and this is pretty well documented, that is called the post-earnings announcement drift. And this is shown in this picture. Okay? So what we see here are days, so time measured in days. And this is again the cumulative, abnormal, or excess return. 10, 9, 8, and so on, these are deciles. So what happens? On day zero, the firm announces its earnings. Okay? Based on the earnings relative to the analyst expectations, we calculate an earnings surprise. So if the analyst expected 1 million loss and we make 2 million loss, the earnings surprise is minus 1 million. If the analysts expect 100 million loss and we make 100 million gain, the surprise would be plus 200 million. So it's always about the new part, the unexpected part, right? So and then based on this earnings surprise, we put the firms into 10 deciles. 10 being the firms with the most positive earnings surprise, and 1 being the firms with the most negative earnings surprise. Okay? So again, on day zero, the earnings are announced, and then we assign firms into this earnings surprise deciles. Okay? So what would we expect in weak, semi-strong form efficient markets? Well, or in efficient markets generally. We would expect basically that before the earnings announcement, on average, there is no price movement, because there is no new information. Then there is the earnings announcement. So for those who are very positive surprised, we would expect the price to jump up and then be flat again. And for those with a very negative surprise, the Eugene Farmer studies suggest that they should jump down and then be flat again. We would expect that all the information, and the earnings are announced on day zero, right? I mean, from day zero, they are public information. And all this public information should be immediately reflected in the prices. That is what the efficient markets hypothesis predicts. What we see in the data is that this is actually not 100% true. There is something that is called the post-earnings announcement drift. So for the most positive surprise firms, the price jumps up, but then it continues to go up for the next 90 days. For the most negative firms, it jumps down, but then it continues to go down for the next 90 days. Very surprising, post-earnings announcement drift. In efficient markets, all the information should be included on day zero. It shouldn't drift after day zero, right? Investors should trade on day zero based on this new information, and that's it. Or in other words, it seems strange that this is happening, because if people know that, I mean that there is a post-earnings announcement drift, why are not more people buying on day zero, pushing the prices up here and making it flat? If you know that there is this drift and this drift, you should sell here and make it flat. If enough people would trade this post-earnings announcement drift would go away. Yeah, why is this existing? Again, these things quickly become complicated. People also suggested some theories. For us, actually, it's not super important. It's just like what we should take away from this is that prices probably not immediately incorporate all the new information. Okay, there is some evidence that markets are not fully efficient as predicted by the theories. They probably are quite efficient, but not fully efficient. Okay, clear? So again, most evidence provides strong support for weak form and semi-strong form efficient markets hypothesis, especially the fact that mutual fund managers, investment analysts, they are not able to beat the market, not on average, and there is also no evidence for strong persistency. Okay. Prices seem to adjust relatively quickly when there is new information, as the early pharma studies showed. So there is quite a bit of evidence that markets are weak and semi-strong form efficient. However, there are also some pieces of evidence against it. Momentum effect is problematic for weak form. And then these anomalies. Small firm effect, also the market to book effect that we need not really talk about. And January effect, and also post-earnings announcement. Okay? So I cannot give you a definitive answer if markets are efficient or not. I would say most evidence says they are semi-strong weak form, but probably there are some anomalies that cannot be explained by these theories. Okay? Now let's move on to the easier part, and the easier part is the strong form efficient markets hypothesis, because the strong form efficient markets hypothesis is widely rejected. Okay? Insiders can make excess profits if they trade their own stocks. That has been widely documented. Illegal insider trading, this is important to keep in mind, is not always illegal. It would be impossible to make all insider trading illegal, because if you are the CEO of a company or CFO or board member or whatever, I mean, a lot of these people, they are compensated with company stocks. So if they want to convert their stocks into cash, at some point they have to sell them. So trading stocks is not illegal for insiders. What makes insider trading illegal is actually a relatively thin line and a complicated question. It's basically trading because you know something that the public doesn't know. It's the intention of the trading that makes it illegal. If you just sell because you want to convert your stocks into cash, because you want to buy a new car or villa or whatever you want to buy, I mean, that's fine. But if you sell your stocks because you know that the FDA will not approve your new drug, and this is the reason why you sell, that this would be illegal. But as you can see, it's not easy to detect why people are selling. I mean, basically you only see that they are selling, but you don't know why they sold. So this is the definition that the SEC states about illegal insider trading, which is also problematic, I think. Illegal insider trading refers generally to buying or selling a security in breach of a fiduciary duty and other responsibility or other relationship of trust and confidence, while in possession of material, non-public information about the security. So it's really basically, yeah, you have some insider knowledge about the firm and this is why you sell. But in practice, in reality, there is a lot of gray. It's not so black and white. Because as you can imagine, obviously, if you are the CEO of a company, I mean, I would hope every CEO is always in possession of material, non-public information. I mean, if you are the CEO and you say, I have no material, non-public information about the company I'm running, I mean, basically, you're not doing your job. So in practice, these things are quite complicated. So the SEC has a hard job actually in detecting legal, in separating legal from illegal insider trading. So what many insiders nowadays do is that they actually follow certain schedules. So basically at the beginning of a year, they already announce that they will sell stocks on April 1st, July 1st, and September 1st. So and then they execute these plans, which makes it easier for them to argue that they did not sell because they had some information. They sold as they already announced at the beginning of the year. Okay? So illegal insider trading was extremely widespread. Probably it still is widespread. Also in the US, surely also in other countries. So these are just some examples of illegal insider trading cases. This is a case from 1990 that nicely shows how the information environment changed. So in 1990, Business Week, the magazine, was still an important news source for investors. So what actually happened is that there were two guys, Jackson and Callahan, and one worked in the shop where this Business Week magazine was printed, and he had access to it before the general public had access to it. So, and then he leaked information to his friend, and his friend traded based on this information. They made quite some money of that. Makes sense, right? It was in the Business Week. The Business Week was not yet publicly available, so this was private information. So you could make profit based on private information. Imclone, Samuel Waxel was also, this was a very, was also a case of insider trading. So actually the CEO, Samuel Waxel, he learned that one of the most important drugs would not get approval by the FDA. So what he then did was to sell stocks, which was probably not the most clever thing to do because the SEC quickly detected that this was illegal insider trading. But yeah, he tried to get rid of the stocks because he anticipated that the stock price would go down. Okay. And these are just kind of relatively random examples. Another very high profile insider trading case was actually Rajaratnam, who was a hedge fund manager, made a lot of money for his clients for some time. And later it came out that probably he made so much money for his clients and he was successful because he had access to inside information, private information. And this case really made headlines because the law enforcement were relatively tough on him. They used wiretaps and stuff like that. And also his sentence, which was originally 19 years, then reduced to 11 years. I think it was then further reduced. But the fact that he went to prison for a long time, I mean, shows that this is not some small petty crime. This is really serious. And for illegal insider trading, you can easily go to jail. So because this case is interesting and a high-profile case, let me show you a short clip about the story of Rajaratnam.
Rajaratnam, a former billionaire Wall Street titan, has been convicted of 14 felony charges alleging he made a fortune off insider trades. The case centered on the testimony of cooperators and secretly recorded phone calls where Rajaratnam could be heard talking to what prosecutors called his corporate spies. In one call, Rajaratnam could be heard grilling former Goldman Sachs board member Rajat Gupta about whether the board had discussed acquiring a commercial bank or an insurance company.
I called you because I am meeting with Gary Cohen on Thursday.
Yeah.
And there's a rumor that Goldman might look to buy a commercial bank.
The investigation saw a change in tactics for the government. Wiretaps were once reserved for organized crime and drug cases.
What we saw in this case was some shift in priorities, and it really occurred before Mr. Bharara, the U.S. Attorney in New York, took office. These wiretaps go back to 2008, and it suggests the government, even under a Republican administration, saw this as just too inviting a target not to use all your enforcement weapons.
Prosecutors had alleged Rajaratnam made profits and avoided losses totaling more than $60 million from illegal tips. As the verdict was read, Rajaratnam sat at the defense table, a rarity for him at this trial, and stayed motionless. Rajaratnam faces more than 19 years in prison. He remains free on $100 million bail and was placed under house arrest at his Manhattan home. Warren Levinson, Associated Press, New York.
Yeah. So insider trading, very profitable, but obviously if you trade like this, very illegal and hefty fines. Good. So let's summarize a bit. What is the evidence? So strong form, that's the easy part, widely rejected. Insiders can make profits, we know that. Okay. Weak and semi-strong form. General markets seem to be efficient in weak and semi-strong form, but some anomalies. Some anomalies became weaker in the recent years, but not all. So book to market, size, momentum, also to some degree January effects still exist. There are different reasons why people say these anomalies exist and how in line with efficient markets they are or not. Palmer and French argue that these anomalies are risk premiums, but not all agree. So again, professional managers, mutual funds, that's probably the most convincing evidence we have in favor of efficient markets. And something that we have completely ignored are behavioral aspects, things like herding, that might also play a role in efficient markets and in any market, and that many people argue could explain some of these anomalies. Good. So what are the implications for investing if markets are weak, semi-strong, form efficient? I mean, if markets are weak, form efficient, what is the value of technical analysis? Well, what is technical analysis? Basically, you try to find price patterns in past historical prices. Like here we have an up channel, a down channel, an up channel, sideways channel, whatever. So those things can become pretty complicated. So this is another technical analysis with a lot of lines. So this is the price of gold, and there's a lot of, I don't know how that exactly works, but basically the people try to find patterns in those prices, and then they make predictions about future price movements, and then they buy or sell. That's the basic idea. So this red line here, this would be the prediction, I think. If markets are weak, form efficient, I mean, all of that is nonsense and a waste of time, because if markets are efficient in the weak form, then past price patterns, trends, and all of that, this would be already priced. And so you would not be able to generate profits based on technical analysis. But we can go even further. What is the value of fundamental analysis? I mean, that is what you do in your term project, basically, right? Running equity valuation models, trying to find undervalued companies. Well, the bad news is that if markets are semi-strong, form efficient, what you're doing is also a waste of time. Because if markets are semi-strong, form efficient, you will not be able to identify mispriced stocks, because you only rely on public information. And all public information is already priced. Okay? So if markets are semi-strong, form efficient, fundamental analysis, looking at public information, reading analyst reports, trying to find over undervalued stocks, is a waste of time, right? Which is not a nice thing to say a couple of days before your term project presentation, I understand. But from a technical perspective, that's true, okay? And also not true. And this is why it's not exactly true, is the so-called Grossman-Stiglitz paradox. Imagine this would be really true. Fundamental analysis is a waste of time. If fundamental analysis is a waste of time, nobody would have any incentive to do fundamental analysis, right? I mean, if it's a waste of time, we don't like wasting our time. It's better to go to the beach or whatever. So the Grossman-Stiglitz paradox then says, look, if fundamental analysis is a waste of time, nobody has incentive to look at annual reports, to read newspaper articles about a company, to listen to CEOs. Nobody has incentive to do that. And nobody will do it. But then how can public information be reflected in the price if nobody pays attention to public information because everyone thinks it's already reflected and it's a waste of time? Okay? So that's the Grossman-Stiglitz paradox. And people struggled with that quite a bit. And the solution, or one proposed solution to the Grossman-Stiglitz paradox is that fundamental analysis itself is probably not a waste of time, in the sense that if you do fundamental analysis, if you do equity research, you probably will be able to generate a higher gross return. Let's say you are able, because you did your research on your companies, you are able to generate a return, investment return of 10%. I'm not doing any equity research. I just believe markets are fully efficient. I only get 8% return. So the 2% return difference that you get over me, that's actually kind of compensation for the time and effort and money you invested in doing the research. So if you subtract your cost from your gross return, you end up at the same net return than I do. We all get 8%. But you have a higher gross return. So you at least get compensation for doing your analyst report, for your equity analysis, and for reading that stuff. So it's not a waste of time in that sense. So there are two alternatives. Get 10% and invest something for it, your time, and probably you have some fees to pay or whatever. Then you get 10%, subtract your cost, you end at 8%. Or you are just passive and say the market knows everything, I just buy, I also get 8%. So two strategies. Some people prefer to do the equity research and they get compensation for that. Some people prefer not to do that. They end up at the same net return. So both strategies lead up to the same net return. So the Grossman-Stiglitz paradox kind of saves your project. It's not a waste of time. And some people need to do that because, again, otherwise markets could not be efficient. We need some people reading annual reports, listening to what company CEOs, executives are saying, so that the prices can reflect this information. Good. So if markets are efficient, relatively efficient, what should we do? I mean, the efficient market, if markets are efficient, investors should not try to outguess the market in a sense. You should not constantly buy and sell securities. This creates cost, this creates trading cost, and it will not profit you because you only can trade on public information, and this public information is already reflected in the price. So I'm not saying this is like, if you believe markets are efficient, this is the most reasonable investment strategy. If you personally do not believe markets are efficient, this might not be the best strategy for you. Okay, so this is not an investment advice. Assuming markets are fully efficient, this is the most rational thing to do. Let's put it like this. So investors should do a buy and hold strategy, purchase stocks, hold them for long periods of time. You will get the same returns than somebody who constantly buys and sells, because this person also has no excess returns because they trade on public information. But you will have fewer brokerage commission costs, fewer transaction costs. Okay. So especially for retail investors, it's typically a sensible strategy to buy a large diversified portfolio that we also know from the CAPM. And how people do that nowadays typically is via passive strategies like ETFs or index funds. Previously, most people used mutual funds, but as I will show you in the next lecture, there's a dramatic shift of money flowing out of active mutual fund strategies into passive ETF strategies. Okay? And these passive strategies are very well in line with this investment idea. You basically do not try to outguess the market. You assume the market is efficient and you just buy the overall market. You're not trying to cherry pick certain stocks. And you should not try to time the market by constantly buying and selling. You just invest long term. Okay? Assuming you believe markets are efficient. Good. That's basically it for today. Any questions? No. Good. Thank you very much. Regular lecture next week.